China just weaponized silver. And what happened next broke a market that's existed for 200 years. Dubai, $127 per ounce. New York, $73. The same metal, the same day. A 70% price gap. Tesla's procurement teams are scrambling. JP Morgan's derivative desk just raised margin requirements 4 times in 14 days. And the US Department of Defense is holding emergency meetings about a metal most people think is just jewelry. Elon Musk made one phone call to his suppliers in January. What he learned should concern every business owner watching this right now, because by summer, this number could hit $200. And if you're not positioned correctly, welcome to Boring Currency Matters, where we discuss the financial developments the mainstream prefers you didn't understand. If you value analysis that doesn't insult your intelligence, the kind of strategic briefing you'd expect in a boardroom, not a circus, I'd appreciate if you'd subscribe. We're building a community of serious people, business owners, investors, professionals who manage real capital. No theatrics, no hype. Just the economic reality they're not putting on the evening news. And before we proceed, drop a comment below. What city are you watching from? New York? London? Singapore? Lagos? I'm genuinely curious where strategic thinkers like yourself are located. Now, let's examine exactly what China just did, and why your portfolio may be more exposed than you realize. On December 18th, 2025, something extraordinary happened in global commodity markets. While Western traders prepared for the holiday season, while liquidity thinned across exchanges in New York and London, the Chinese Ministry of Commerce published a single-page document. Export licensing requirements for refined silver, effective immediately. Most analysts dismissed it as bureaucratic paperwork, another regulatory formality in a country known for administrative complexity. They were catastrophically wrong. Within 72 hours, the global silver market fractured in a way financial historians had never documented. Physical silver in Dubai began trading at $127 per ounce. Paper silver contracts in New York, $73. The same metal, separated by a 70% price gap. This wasn't a temporary dislocation. This was structural market failure. To understand why this matters, one must first understand what China actually controls. 70% of the world's refined silver production flows through Chinese processing facilities, not mining, processing. The distinction is critical. Raw silver ore exists in Mexico, in Peru, in Australia. But transforming that ore into the pure metal required for electronics, solar panels, and industrial applications, that happens predominantly in China. For decades, this arrangement functioned seamlessly. Ore flowed in, refined silver flowed out, and global supply chains hummed along without disruption. December 18th changed everything. The new licensing system didn't ban exports. It simply required government approval for every shipment. Applications would be reviewed, considered, processed through appropriate channels. No timeline was provided, no criteria were published. Chinese refineries could still sell domestically without restrictions, but international buyers suddenly found themselves in bureaucratic limbo. Within days, the effects rippled across industrial sectors. Tesla's procurement teams discovered they could no longer secure reliable silver deliveries for the 25 to 50 grams required in every vehicle they manufacture. Solar panel producers watched their input costs spike, as the photovoltaic industry consumes approximately 100 million ounces annually just in the United States. Electronics manufacturers faced similar constraints. Every smartphone contains trace amounts, every computer, every electrical switch. But here's what separated this crisis from typical supply disruptions. The arbitrage mechanism broke. In functional markets, when prices diverge geographically, traders buy low in one location and sell high in another, closing the gap through profit-seeking behavior. If silver trades at $73 in New York and $127 in Dubai, an arbitrageur should buy American, ship to the Middle East, and pocket the difference. Except they couldn't. Chinese export restrictions meant Western silver remained trapped in Western vaults, unable to flow toward premium pricing in Eastern markets. And Eastern physical silver, already scarce due to years of industrial consumption, couldn't replenish Western inventories. The global silver market had effectively split into 2 separate markets, operating under completely different price discovery mechanisms. On January 9th, 2026, Elon Musk held a video conference with Tesla's critical materials procurement team. The details of that call remain private, but 3 suppliers independently confirmed the same message reached their organizations within 24 hours. Secure physical metal immediately, at any reasonable cost. This wasn't Musk's typical public commentary. This was internal corporate intelligence, and it signaled something crucial. The world's most supply chain sophisticated manufacturer, a company that revolutionized automotive logistics, couldn't solve this problem through operational excellence. The metal simply wasn't available at previously normal prices. Financial analysts began comparing the situation to the 1980 Hunt brothers silver crisis, when two Texas billionaires attempted to corner the market, driving prices to $50 per ounce before regulators intervened. But this situation differed fundamentally. The Hunt brothers represented speculative manipulation, artificial demand created by individual actors. China's export licensing represented geopolitical strategy, a sovereign nation converting an industrial commodity into economic leverage. No regulatory intervention could force a foreign government to reverse policy. By late January, refineries in Switzerland and the United States reported unprecedented behavior. Industrial buyers offering 8-week premiums, paying significantly above spot prices for guaranteed delivery 2 months ahead. This signaled genuine shortage, not trading volatility. When manufacturers pay premium prices for future delivery, they're communicating that their production lines face existential risk without that material. The implications extended beyond immediate pricing. For the first time since the breakdown of Bretton Woods, a major industrial metal had been successfully weaponized by a single nation. And the West had no strategic reserve, no domestic refining capacity, no immediate countermeasure. China had identified a critical vulnerability in global supply chains and exploited it with precision timing. What happened next would expose just how fragile the paper silver market truly was. The COMEX silver vaults in New York hold 42 million ounces of registered inventory. Registered? Meaning available for physical delivery to contract holders who demand actual metal instead of cash settlement. Against that 42 million ounces, there are outstanding paper contracts representing 890 million ounces, a leverage ratio of 210 to 1. For decades, this system functioned because almost nobody took delivery. Traders bought contracts, held them briefly, sold them for profit or loss, and moved on. Physical delivery requests represented less than 2% of total trading volume. The entire architecture of the paper-silver market depended on one critical assumption. That assumption was about to detonate. January 14, 2026. The Chicago Mercantile Exchange made an unusual announcement. Margin requirements for silver futures contracts would increase by 18%, effective immediately. Traders who wanted to maintain their positions would need to deposit significantly more collateral. 3 days later, another increase, 14%. 4 days after that, another 11%, then again 9%. 4 margin increases in 14 days. A cumulative jump from 40% initial margin to 68%. This wasn't normal market behavior. This was institutional panic. Margin increases serve one primary function: forcing leveraged speculators to either post more cash or liquidate their positions. The CME was deliberately making it expensive to hold long silver positions that could potentially demand physical delivery. But why would the exchange want to discourage delivery requests? Because the mathematics had become impossible. March contract holders, traders who had purchased the right to take delivery in March 2026, represented 190 million ounces of potential delivery demands. The available registered inventory, 42 million ounces. If even a quarter of March contract holders demanded physical metal, the COMEX couldn't fulfill those obligations. The exchange would default. And behind this inventory crisis sat 3 major banking institutions: JP Morgan, HSBC, Citibank, combined derivative exposure, $47 billion notional value. These banks hadn't simply facilitated silver trading, they had sold massive short positions, betting that silver prices would remain stable or decline. Their hedging strategies assumed one fundamental condition: continuous Chinese refined silver exports. December 18th destroyed that assumption. When China implemented export licensing, these banks suddenly held short positions against metal they couldn't source at contracted prices. Every dollar silver climbed above their short positions. They lost money. But the problem extended beyond simple trading losses. These weren't speculative positions. They were hedges against forward production sales. Mining companies had sold future silver production to these banks at fixed prices. The banks had hedged those commitments by selling futures contracts. And everyone assumed Chinese refineries would process the ore into deliverable metal. Now, the ore still existed, but the refining capacity sat behind Chinese bureaucratic approval processes with no defined timeline. The banks had sold silver they could no longer guarantee they could deliver. By late January, whispers began circulating through institutional trading desks. COMEX officials were quietly approaching large contract holders, offering cash settlement premiums. Instead of delivering physical silver, the exchange would pay contract holders above market prices to accept cash. For most traders, this represented acceptable resolution. They had purchased contracts for price exposure, not because they needed actual metal, but Asian buyers, particularly industrial manufacturers and sovereign wealth funds, were rejecting these offers. They didn't want cash. They wanted physical silver, and they were willing to wait, willing to force delivery, willing to expose the inventory deficit. Refineries in Switzerland reported extraordinary developments, clients offering premiums for immediate physical delivery, not the standard 2 to 4 week settlement, but premium pricing for metal available within 48 hours. One Swiss refinery documented an offer of $143 per ounce for immediate pickup. The COMEX spot price that same day, $76, an 88% premium for immediate physical possession. This behavior indicated something far beyond normal market volatility. Industrial buyers were signaling they faced production shutdowns without immediate silver access, and were willing to pay almost double the paper price to avoid that scenario. The banking institutions understood the implications. If the March contracts forced widespread physical delivery demands, if the COMEX couldn't fulfill those obligations, if the exchange defaulted or suspended physical settlement, confidence in paper precious metals markets would evaporate. And these banks held derivative positions across gold, platinum, palladium, not just silver. A COMEX default would trigger questions about every precious metal derivative, every futures contract, every hedge fund strategy built on the assumption that paper contracts represented legitimate claims on physical assets. The systemic risk extended beyond commodities into currency markets, because silver, unlike most industrial metals, maintains monetary properties. Central banks don't hold copper reserves, but they do hold silver. If paper silver markets collapsed, it would raise uncomfortable questions about the relationship between physical assets and financial derivatives across every market. February 1st, JP Morgan's commodity desk published an internal memo. The details remained confidential, but 3 separate sources confirmed the essential message. Reduce silver short exposure, prioritize physical acquisition, prepare for potential delivery obligations. The derivative time bomb was counting down, and no one knew exactly when it would detonate. On January 23, 2026, a closed-door meeting occurred in Washington that received zero media coverage. Representatives from the Department of Defense, the Department of Energy, and the Treasury's Office of Foreign Assets Control gathered in a secure conference room. The agenda had one item: critical materials procurement in a constrained supply environment. The focus: silver. Most Americans think of silver as jewelry, as investment bars, as collectible coins. The U.S. military thinks of it very differently. Every Tomahawk cruise missile contains approximately 120 ounces of silver in its guidance systems. Every F-35 fighter jet, 350 ounces in electrical contacts and radar components. Every naval destroyer, thousands of ounces in weapon systems and communications equipment. Annual military consumption, 180 million ounces. And in January 2026, procurement officers couldn't guarantee uninterrupted supply. This wasn't theoretical concern. This was operational crisis. Defense contractors who had delivered components on predictable schedules for decades were suddenly requesting delivery extensions. 6 weeks became 8 weeks, then 12 weeks, then requests for indefinite postponement until silver availability stabilized. The Pentagon faced a problem it hadn't encountered since World War II. A critical war material, controlled by a strategic competitor, with no domestic alternative. The United States mines silver, approximately 33 million ounces annually, but that ore requires refining, and American refining capacity handles roughly 40% of domestic need, the remaining 60% historically sourced from China. Military planners examined historical precedents. 1973, the Arab oil embargo, when OPEC nations weaponized petroleum exports. The U.S. responded by creating the Strategic Petroleum Reserve underground storage facilities containing hundreds of millions of barrels. 2020, the pandemic PPE shortage, when global supply chains for masks and medical equipment collapsed. The government invoked the Defense Production Act when directing private manufacturing toward critical needs. 2021, the semiconductor shortage, when automotive and electronics production stalled. Government agencies coordinated allocation frameworks, prioritizing critical infrastructure over consumer goods. Silver in 2026 presented elements of all 3 crises, combined. It was energy critical. Biden administration clean energy mandates required silver-intensive solar panels. 100 million ounces of annual U.S. solar industry demand, suddenly facing 70% cost increases. Projects that penciled at $70 silver became economically unviable at $127. Federal renewable energy targets, tied to international climate commitments, now threatened by commodity supply constraints. It was defense critical. Missile production, aircraft manufacturing, naval systems, all dependent on consistent silver supply. And it was economically critical. The entire electric vehicle transition required silver. Every EV contains 2 to 3 times the silver of traditional internal combustion vehicles, Tesla, Rivian, Ford's electric division, GM's Ultium platform, all facing the same procurement crisis. Projected 2026 U.S. electric vehicle production, 1.8 million units. Estimated silver requirement, 150 million ounces. The administration faced an impossible choice: prioritize defense production and sacrifice clean energy targets, prioritize renewable energy and constrain military readiness, or compete in open markets, driving prices even higher, and watch both sectors struggle. February 2nd. The Department of Energy quietly activated emergency procurement protocols. Not publicly announced, not widely reported, but documented in federal contracting databases for anyone paying attention. Agencies could now invoke priority delivery clauses in existing contracts. Government orders would receive preferential treatment over private sector purchases. The precedent dated to World War II, when military production took precedence over civilian goods. Aluminum went to aircraft manufacturers, not automobile companies. Steel went to shipyards, not construction firms. Rubber went to military vehicles, not consumer tires. The allocation framework was resurrected, adapted, and quietly implemented. Solar developers began receiving notifications. Project timelines would extend, material costs would increase, and delivery schedules would depend on availability after priority contracts were fulfilled. The cryptocurrency mining industry, which uses silver-containing semiconductor chips, received similar messages. Operations consuming megawatts of electricity to process Bitcoin transactions represented lower national priority than defense contractors producing missile components. Hash rate implications began emerging in blockchain analysis. If chip manufacturers prioritized government contracts, mining hardware production would slow and Bitcoin network security could face constraints. But the most significant development involved international coordination. U.S. agencies contacted counterparts in allied nations, Australia, Canada, Japan, South Korea. Discussions centered on coordinated procurement, shared refining capacity development, and strategic reserve establishment. The conversation that emerged looked remarkably similar to Cold War strategic planning, identifying critical vulnerabilities, developing domestic alternatives, reducing dependence on adversarial supply chains. Silver had become more than an industrial commodity. It had become a national security priority, and the government was preparing to treat it accordingly, whether the private sector was ready or not. The era of pure market-based allocation was ending. The era of strategic resource management was beginning. The question every business strategist was asking by February 2026 had nothing to do with technical analysis or chart patterns. It was simple mathematics. If Chinese export restrictions continue, if COMEX inventory depletes at current rates, if industrial demand remains constant, where does the price go? Analysts began constructing models based on supply deficit arithmetic rather than speculative forecasting. The calculations were straightforward. Western available inventory in approximately 200 million ounces across COMEX, LBMA, and private vaults. Annual industrial consumption in non-Chinese markets, roughly 450 million ounces. Mining production that doesn't require Chinese refining, 140 million ounces. The gap, 310 million ounces annually. At current consumption rates, Western physical silver depletes entirely by June, unless prices rise high enough to destroy demand. That's where $200 per ounce entered the conversation. Not as speculation, but as the mathematical midpoint between current conditions and genuine shortage rationing. Dubai physical premiums already demonstrated $127 pricing in January. If supply constraints persist through summer, and if industrial buyers face production shutdowns without metal access, panic pricing could push spot markets toward $250 or higher. $200 represented the threshold where certain industrial applications become economically unviable, reducing consumption enough to balance against constrained supply. Financial historians noted the parallel to 1980. Silver peaked at $50 per ounce that year during the Hunt Brothers crisis. Adjusted for inflation to $2026, that's $185. The current situation involved actual supply disruption, not speculative manipulation, which suggested prices could exceed historical inflation-adjusted peaks. But here's what separated institutional analysis from retail speculation. Sovereign wealth funds weren't buying silver because they predicted $200 prices. They were buying because correlation analysis showed precious metals as optimal portfolio hedges against the specific risks emerging in 2026. Geopolitical commodity weaponization, derivative market stress, government intervention in industrial allocation. These conditions historically correlate with monetary metals outperforming traditional assets. Norway's government pension fund, Singapore's GIC, Abu Dhabi Investment Authority, all quietly increased physical precious metals allocation in January. not through mining stocks or ETFs, physical metal and secure storage facilities. Pension funds reviewed commodity exposure mandates. Family offices established vault agreements with Swiss depositories. This wasn't retail speculation driven by YouTube predictions. This was institutional capital responding to structural market changes. Corporate treasurers faced different calculations. Companies with direct silver exposure, electronics manufacturers, solar developers, medical device producers, they weren't buying silver as investment. They were securing operational continuity. Forward purchasing agreements at premium pricing functioned as insurance against production disruptions. If a solar company's projects require guaranteed silver delivery to maintain construction schedules, paying $140 per ounce today might be cheaper than project delays costing millions in financing carry costs and contractual penalties. The decision framework for business capital allocation centered on three considerations. First, direct operational exposure. Companies requiring physical silver for production faced binary choice, secure supply or face shutdown risk. Second, portfolio correlation benefits. For businesses holding significant cash reserves, precious metals provided hedge against the exact policy responses governments were implementing. Emergency procurement programs, strategic allocation frameworks, potential currency interventions, all historically correlate with monetary metals appreciation. Third, percentage-based position sizing. Institutional risk management never involves all or nothing decisions. A manufacturing firm might allocate 5% of treasury reserves to physical silver, enough to benefit from appreciation without creating excessive concentration risk. But the most critical distinction involved physical versus paper exposure. January's COMEX margin increases and cash settlement offers demonstrated that paper contracts might not deliver physical metal when actually needed. Businesses requiring actual silver, not price exposure, increasingly demanded vault storage receipts rather than futures contracts. Swiss refineries reported waiting lists for allocated storage, clients willing to pay storage fees for guaranteed physical possession. This behavior indicated something beyond normal investment demand. It signaled that sophisticated capital allocators believed the paper market might not survive in its current form. By mid-February, the strategic assessment crystallized. This wasn't a trading opportunity requiring perfect market timing. This was a structural supply emergency requiring strategic corporate response. Business owners managing working capital, investors overseeing family wealth, corporate treasurers responsible for operational continuity, all face the same fundamental question. In an environment where a critical industrial material has been weaponized by a strategic competitor, where government agencies are implementing allocation frameworks, where paper markets show signs of potential delivery failure, where physical premiums already demonstrate 70% dislocations, what percentage of capital belongs in hard assets that can't be created by policy decisions or derivative contracts? The answer to that question would determine which businesses navigate the crisis successfully, and which discover their assumptions about market functionality were catastrophically outdated. The $200 trajectory wasn't prediction. It was mathematical destination, unless something fundamental changed in global supply dynamics, and nothing suggested that change was coming.